Good morning, everyone. You are watching a live daily market outlook for Monday, 16th of April, 2012. Beginning of the week brings a more grim picture in the markets as the black clouds are again coming over the Eurozone's economy, pushing the single currency again lower as it lost traction on its latest recovery attempt with, a latest price action seen of last week's peak at 132.11, now significantly losing the ground with the break of initial supports at 130.32, now testing 130.00 zone, support zone that was already dented briefly. The growth in emerging economies is slowing, and recovery in the United States could be losing some momentum. Were some developments when European leaders have yet to complete the repairs needed to shore up monetary union. The situation currently forms a vulnerable backdrop for finance officials from the world's leading economies that gathered in Washington during the weekend for the group of 20 and the International Monetary Fund and the World Bank meeting. The best definition for the current situation was given by Director of IMF, Mrs. Christine Lagarde, who said that risks remain high and the situation fragile. As said, the main fear now comes from Spain, as these soaring bond yields now putting additional pressure in the markets. The recent raise in the yields to over 6% are actually one of the main reasons for the recent slump of the euro, as it hit currently 1 month low against the dollar and the 1.5 year against the British pound. The news over the weekend that China doubled the yuan's daily trading band against the dollar to 1% has so far had limited impact on the major currencies, with the market players still struggling to figure out its implications. As said, the most fearing moment is the Spain government bonds that yields rose, and the cost of insuring its debt hit an all-time high last Friday, as record borrowing by its banks from the European Central Bank highlighted the fears about the country's finances before it tests market appetite for its debt on this week on Thursday. Data released showed that Spanish banks borrowed a record of 316.3 billion euros, equivalent to approximately $412 billion from the European Central Bank in March. That marks almost double of the previous month total, as they remained virtually excluded from wholesale credit market. The European Central Bank Governing Council member Klaas Knot said on Friday he did not expect ECB to provide more cheap 3 years cash, and hoped the bank never has to buy bonds again. However, Knot said that ECB could still support the bond market should it need arise. As euro came under pressure, further outlook for the single currency remains quite negative, with downside vulnerable, as well as dollar that is now gaining momentum again against most of the majors, except yen, where the pair lost some important support levels and heading south as a part of the larger correction of the broader up move from 76 to 84.17 as a result of current risk aversion. The gold and the crude oil lost ground again. Crude oil is currently moving around $102 per barrel, with outlook still keeping the downside vulnerable and looking for possible test of the last week's lows under $101, and looking possibly for test of our key psychological support on the downside at $100 per barrel. The gold also lost traction on its after it approached and briefly broke the initial resistance at 1683, with the latest developments in the markets pushing the yellow metal significantly lower. currently moving around 1644 with the 1641 low seen so far. This was the low of the day posted earlier today, with outlook also for gold being quite negative and offering more space for bears that started developing as the price upside was rejected at 1686, just above our initial resistance. More interesting is outlook for oil that came again under heavy pressure as weak growth numbers coming from China, which is number 2 oil consumer, as well as the Spanish surge in Spanish borrowing costs triggered renewed fears about global economic growth and demand. Basically, the current situation with Iran, that was the main boost for the high oil prices, has been offset by the current news from China and from also the situation in the European Union, with the Spanish problem now coming in focus. China's economy grew 8.1% in the first quarter from 8.9% in the previous quarter, but still weaker than expected, and it's the slowest growth in nearly 3 years. That raises fears that downward drift will extend into second quarter and possibly dampen the oil demand. A stronger dollar also, and the jump in the cost of insuring Spanish debt against default to a record high that we already mentioned. The renewed worries about the Eurozone debt crisis is additional pressure for the oil prices. From the other side, more tightening in the sanctions towards Iran is seen, as the Barack Obama, President of the United States, said if there will be no movements and the progress in the current discussions with Iran, then they will have no other choice than to tighten the already quite tight sanctions towards Iran to bring it to the higher level. As just a reminder, the America and the Eurozone imposed tough sanctions that are banning all European and US European countries and US of importing Iranian oil. However, the current fears in the market of weaker demand are now offsetting these fears of the possible further conflict with Iran, with also the help given from the Saudi oil minister Naimi that we mentioned in last session on Friday, that Saudi Arabia offered as much as possible help, even to increase their production to the maximum, in order to cover any possible gaps that might come on the complete shortage of Iran, of taking Iran out of the world oil supply. From today's calendar, brief look, some events are due today, starting day with the Switzerland. 7:15 GMT we have the PPI March release, 0.5% forecast compared to 0.8 of the previous month. Eurozone trade balance is due at 9 o'clock. February release, narrowing gap to minus 2.27 billion euros compared to minus 4.35 billion euros gap of the previous month of January. That might be giving some a positive tone. However, the gap is still existing there, and a lot of effort needs to be done, and in order to bring these numbers into the positive. From America's Canadian foreign securities purchases February release are due at 12:30 GMT. 723 billion Canadian dollars is the forecast for today, compared to negative minus 4.19 billion of the previous January release. U.S. retail sales at the same time, March release, 0.4% is forecasted for today, compared to much better results in February of 1.10%. Core retail sales are also forecasted to drop by 0.6% compared to 0.9% of the previous February release. U.S. Empire State Manufacturing Index, a slight decrease, 1820 is today's forecast compared to 20.20 of the previous month release. Tick long-term purchases from US at 1300 February release, $41.3 billion, much lower from the previous 101 billion US dollars. At 1400 GMT business inventories from US February release, no change, 0.7% forecast for today. And the NAHB housing market index from states, also no change, as the forecast is 28 today compared to the same release of month of March. Important to say that a survey of about 900 home builders, which asks respondents to rate the relative level of current and future single-family homes sales, still holds below 50, which is the border. Holding above 50 would indicate a favorable outlook in the home sales, while below 50 indicates a negative outlook. So housing market in states, according to this indicator, is still deeply into the negative territory. From speakers, we have at 16:30 GMT FOMC member Sandra Pianalto, who is due to have a speech. That was all from today's calendar. Now we're going to take a look in the markets and have some more detailed look into the technicals of majors and commodities. As said, the euro is sharply lower as from last Thursday's peak of 132.11, accelerating losses on Friday, with the overnight's also action breaking below the previous support at 130.32. Currently 129.93 is the low of the day, slightly below the 130.00 support, the previous low of 15th of March 2012. The pair is now into the entering the dangerous zone with critical supports at 130 and 129.73. Also, we have the 61.8% of the latest uplift from 126.22 yearly low to 134.85 year-to-date high of euro dollar, and break of this. And this is also the floor of the past 2 months and something range, a break of which would significantly weaken the already weak structure of euro dollar, signal end of this corrective phase that lasts from beginning of mid-January 2012, and likely to open way towards 126.22 yearly low. Some minor supports are seen at 128.75, and also we have the previous lows at 128.72. So this is actually the strong support at this point, ahead of 126.22, which is the key longer-term support low of 2012, posted on 13th of January 2012. On the near-term outlook, negative structure on the 4-hour chart, as well as hourly, with some attempts of basing at this point, as the studies hit their extreme downside levels on the hourly chart, with some consolidation, possible bounce higher seen at this point. The immediate static resistance comes at 130.50 zone, where is also the 20 days exponential moving average, and likely is expected to limit any corrective action for now, with the focus firmly being on the downside. Also, daily structure shows the studies all in the negative territory alone and all pointing lower, with the last Friday's break of 90 days moving average. Actually, today's break at last Friday, at 131.03, now leaving opening a way for further extension lower, with critical supports 130, 129, 70, 50 zone seen in the near term. Also, Ichimoku studies are now firmly negative, as all indicators pointing lower, and the pair finally broke below the cloud base at 130.50 zone that offered some support during the past week or so. Now firm break below the cloud would signal further weakness of the pair, as studies now in Ichimoku are confirming its negative structure, and looking for further extension lower. Cable also along with euro lost ground off its recent high at 159.84, pardon, posted last week on 12th of April. Since then, the pair is in a down move with the break of initial support at 159 zone, accelerating losses to the next stage of 158.40 that was seen last Friday, where brief consolidation preceded fresh weakness. Break below this level so far hit 158.20 ahead of our key support at 158.00 zone. As we can see, this is the double bottom of 5th and 10th of April 2012 with immediate threat of retesting this level that might trigger further weakness. More significant situation is shown on the daily chart, where the pair again broke below 200 days moving average and also briefly dented the main bull trend line drawn of 152.33 yearly low of 13th of January, with loss of the higher platform at 158 zone to further weaken the structure. Below this level we have minor support 157.69 and then 38.2 Fibonacci retracement of the entire up leg from beginning of year from 152.33 that peaked at 160.61 at the beginning of April. That loss of which would confirm the again negative structure, keep the pair still within this range of beginning of February 2012 that is defined on the downside by 156 and on the upside by 160.61, as the initial sealing of the range at 159.70-80 zone was briefly taken out to 160.61, but the pair quickly reversed into the range, and basically on the larger picture only loss of 156 low of 12th of March 2012 would signal further more significant weakness and possibly open way for test of 152.33 yearly low of cable. On the downside, as main supports have been dented, 158.41 200 days moving average, as well as main bull trend line. Now the main focus is at 158.00, 157.69 and the 157.45, loss of which to open 156, and then again very strong support at 156.50 zone, where you have previous lows, as well as 50% retracement. On the upside, the key barrier is last week's high at 159.84, and only break of this level would more significantly improve the structure. The studies have lost momentum on the daily chart, with the MACD still pointing lower, still holding above the midline, but pointing lower, and the sustained break below the 200 days moving average and the possible break below 158.00 strong support is required to confirm the negative structure, mark the top at 160.61 in favor of further extension lower. Studies on the near term are also negative for our studies, all in the negative territory, with current corrective attempts seen already turning the RSI towards the upside, as said around 159, where is the 20 days exponential moving average on the 4-hour chart that recently crossed below 55 days one, is expected to cap any stronger corrective action, and no further break unless firm break above 159.50. Otherwise, the downside will remain in the focus for now. The dollar yen has ended its near-term recovery attempt, of previous low at 80.57. This is the higher base of 6th and 7th of March 2012, with brief correction higher being capped around the 81 zone. There was a tick above this level at 81.18 seen last Friday, with the fresh weakness and now putting pressure again on the pair as it broke below previous low at 80.57. So far we have seen 80.44 low with negative structure on the hourly as well as 4-hour chart, keeping the downside favored. As we can see on the 4-hour chart, the 20 days moving average capped all the time this corrective, brief corrective action of 80.57, making it just a mild consolidation ahead of further weakness. The situation on daily chart remains fairly negative as the MACD also broke below the center line, setting a potential for a further extension higher. All studies are pointing lower, with the recent break of 55 days moving average opening way for test of the next very significant support at 80.00 zone. 80.09 is 50% retracement of the entire move from 76 to 84.17. And then static support at 80.00 low of 28th of February 2012. For now, recent range highs at 81, 81.18 are offering initial resistance ahead of 55 days moving average at 81.41, and more significant lows at 81.50 zone, as well as previous high of 10th of April at 81.81. Basically, only firm break above 82.00 would ease the current bear pressure. Until then, the downside remains in focus, with the 80.00 zone seen as the next target in the short term. The dollar Swiss regained strength again after a brief pullback of 92.21, 5th of April low that dipped as low as 90.91 zone was our break point, as I mentioned in our previous studies and the written analysis, that only break below 91 would harm the structure. However, there was a brief break below 91 that found support just under this level, and fresh strength as the dollar regains ground pushed the pair significantly higher. Overnight's break above previous high at 92.21 now opens way for further extension higher, with the 92.50 seen so far. On the daily chart, we can see that the pair broke below the main bear trend line, as well as a brief break above 92.30, 90 days moving average that opens way for test that is coming. The next one, 50% retracement of the entire down move from yearly high at 95.93 to the yearly low at 89.29 posted on 24th of February 2012, opening the way for a test of 92.61, the 50%, and then the next static resistance and the round figure resistance at 93 zone seen next, ahead of our key short-term barrier at 93.33, 15th and 14th March of 2012 highs. Outlook for dollar Swiss on the daily chart is improving now, as studies are breaking above their midlines, with the current break of trendline resistance and the 90 days moving average seeing potential for possible test of 93.30 zone in the short term. Main support for now remains at 91.00, 90.90, ahead of another strong one at 90.30, the trendline support, and the previous low at 90.00, with the loss of the later two weaken the structure again, and the open test for the yearly low at 89.30. For now, the structure on the near term outlook remains positive. However, some overbought conditions are seen on the hourly chart, as studies are quite extended at this point, suggesting that corrective consolidative phase might precede a fresh rally, with the previous highs at 92.15, 92.00 now offering initial support, along with the 20 days exponential moving average as shown on the hourly chart. Previous high and the moving average is now actually the initial support, while only loss of levels around 91.70-80 would more significantly weaken the structure. For now, the positive outlook remains in play, with the, as said, quite extended studies on the near-term outlook, seeing potential of corrective consolidative action of dollar Swiss. As mentioned at the beginning of the session, the gold, after a nice rally from 1612 low of 4th of April 2012, and the signals of breaking above 1683, our initial resistance, also the trend line resistance at 1676, were short-lived as the gold hit 1686, and that was all seen running out of steam just ahead of our next significant barrier, 1697, 1700. A sharp decline followed. So far it traced 61.8% of the latest up move from 1612 to 1686, turning the outlook negative. The 4-hour charts studies are all pointing lower, with the 20 days moving average now attempting to break below 55. One to give further signals of weakness. On the hourly situation is negative. Studies are negative, quite extended, with RSI dipping under the oversold signal line, currently attempting above it, signaling a possible near-term basing attempt, corrective action before the bears reassert. Immediate resistance on the upside is around 1650, where is also close to it is the 20 days moving average that already crossed on the hourly chart below 55 days, and this zone is basically 1650, 1660 is expected to cap the upside, as we have the previous top at 1663 of 10th of April, is expected to cap any corrective action ahead of further weakness. On the daily chart, negative outlook keeps the downside in focus, as the upside failure at 1686, just under 1697, 1700. Also the 200 days moving average now is looking to confirm the lower top at this point for further extension lower. Possible test of static support 1628, previous low of 22nd of March, as well as 1620, which is the main bull trend line of 2011 low at 1522, as well as key short-term support at 1612 low of 4th of April, break of which to signal further extension of the downtrend from 2012 high at 617.90 that was posted on 29th of February 2012, just against 2011 high at 1802. So the negative structure continues to pressure the yellow metal after a failure to extend the recent recovery and regain some very important levels. So far, these levels at 1700 zone are capping firmly the upside for now, and further strength of the dollar and risk aversion might see further weakness of the yellow metal. And finally, a brief look at crude oil that remains in the firm channel of 110.53 yearly high posted on 1st of March 2012, with the recent action again turning lower after initial corrective attempt of 167 10th of April high, broke some important barriers at 103 and 103.38, but failed to sustain gains, as the pair also broke $104 per barrel, holding short of our initial resistance and previous range floor at 104.30. As the gains were limited at this point, further weakness followed. Currently, the pair is moving around the price is moving around $102 per barrel, with the still negative outlook on the 4-hour chart, as all studies are still pointing lower, with some basing attempt seen at this point, as 4-hour momentum is now regaining some strength, but 20 days moving average at 102.62 and 55 days at 103 are offering quite good resistance at this point, and basically only break above previous high at 104.22 would avert immediate downside risk. On the hourly chart, situation remains firmly bearish, as studies are still pointing lower, but approaching the negative, the oversold territory that might signal some corrective action. As mentioned previously, only break above 104, 104.20 would improve and confirm the lower, higher low at these points. Otherwise, likely scenario would be retest of 101 and 167 that may open way for a test of our key downside support at $100 per barrel. That is actually the short-term target. On the upside, as said, 103.70 zone is the previous range ceiling, and 104.20 are offering a good resistance, where is also 55 days moving average that currently caps the upside. Only break above these levels would avert immediate downside risk. Otherwise, we might see the test of 167 and further down $100 per barrel. That was all for Monday, 16th of April 2012. We are back tomorrow at the same time at 7:00 GMT. Until then, I wish you good luck and a nice day. Thank you.